and Assalamualaikum. My name is Muhammad Haqiemi AZAR. I'm from JBA 2423B. Today I will talk about capital structure. Okay, first we will talk about capital structure. Capital structure describes the relationship between various long-term funding sources such as stockholders, equity and preferred stock, as well as debt financing. Choosing an appropriate capital structure is a critical choice for financial management since it is directly tied to the firm's worth. A company's total capital may be raised by a variety of means, including shares, debentures, and other long-term borrowings. While equity shares are not subject to a fixed charge, preference share and debentures are required to pay dividends or interest. Thus, debentures and preference shares impose a set fee on the holder. Capital structure refers to the portion of the financial structure that consists of long-term sources. Generally, the word capital structure refers to just long-term debt and total shareholders' investment. It's a combination of long-term assets such as stock, cash reserve, and surpluses, as well as long-term loans from outside the company. You guys might be wondering, what is capital structure? Capital structure is one important part about a company's capital structure. It is a specific combination of debt and equity. Equity capital, or the firm's ownership interest, is a claim on future cash flows and profitability of a corporation. Debts include things like bonds, loans, whereas equity include things like ordinary stock, preferred stock, and retained earnings. The capital structure includes short-term debt as well. Then, on the balance sheet, the assets of the company which appear on the balance sheet as well are acquired via the use of loan or stock. Considering capital structure in this way allows you to see it as a mix of long-term debt, current obligations, common equity, and preferred equity. A company's capital structure is examined by looking at the short-term debt to long-term debt ratio. When discussing capital structure, analysts look at a company's debt to equity ratio to see how risky its borrowing practices are. When a company has a high debt to equity ratio, its capital structure is more aggressive, putting investors at risk. This danger, on the other hand, may be the main driver of the company's expansion. Okay, now we will talk about how to determining optimal capital structure. A business optimum capital structure is the best mix of debt and equity financing that maximizes market value while minimizing capital expenses. Debt financing, by definition, has the lowest cost of capital due to its deductibility from taxes. Excessive debt, on the other hand, increases the financial risk to shareholders and lowers the needed return on equity. As a result, organizations must calculate the optimal level of debt at which marginal profits equals marginal expense. Managers frequently strive to operate within a range of values due to the difficulty of defining the appropriate capital structure. They must also take into account the signals that their funding choices send to the market. First method is by minimizing dilution and giving negative signals to the market. A firm with promising future would seek to obtain financing via debt rather than shares. Announcements about a corporation incurring debt are often seen as favorable news, a practice known as debt signaling. If a firm raises too much money in a short period of time, the cost of debt, preferred stock, and ordinary equity will begin to climb, raising the marginal cost of capital. Secondly, the debt or equity ratio is then used by prospective equity investors to assess the riskiness of a firm. Another way to determine if a firm is utilizing excessive debt in its capital structure is to look at how leverage other companies in the same sector are using, assuming that these companies are functioning with an optimal capital structure. Another method is to act like a bank when determining optimal debt to equity ratios. what is the maximum amount of debt that bank will lend additionally, and analysts may use other debt ratios to assign the firm a credit profile through a bond rating. The default spread associated with the bond rating may then be used to calculate the spread over AAA-rated companies' risk-free rate. Okay, now we will discuss factors affect capital structure and capital structure decision. The capital structure's main division is between debt and equity, and the percentage of debt financing is quantified via gearing and leverage. There are few factors affect a company's capital structure, and a firm should strive to identify its optimum or best funding combination. The factors are divided in two, which are internal and external. One of the internal factor is asset structure. Funds are required to invest in both fixed and current asset. Long-term sources of funding may be used to fund fixed asset investment via the issuance of shares, debentures, or preferred stock. Then, long-term sources fund a part of current asset investment. In addition, to fulfill the working capital need, short-term sources are utilized. As a result, asset structure, both fixed and current asset, affects capital structure. Secondly, cash flows. From what I understand, a company's cash flow capacity will have a direct effect on its capital structure. The ability of a company to generate cash flow enhances the freedom of the finance management in determining the capital structure. Cash produced by a business or availability of a constant flow of cash boosts a company's image. The company's cash flow allows it to fulfill its short-term commitments. A company will be required to pay dividends to equity owners as well as interest to bankers and debt holders. The company's ability to generate cash flow aids in fulfilling this promise. Sound cash flows make it easier for the finance manager to get money via loans. Thirdly, risk. Generally, debt securities start raising risk, whereas equity securities decrease risk. Risk may be quantified to some degree via the use of ratios, measurements, gearing, and time interest generated. The danger associated with the usage of leverage is referred to as financial risk. The use of debt introduces financial risk due to the greater unpredictability in shareholders' profit and the possibility of bankruptcy. By not using borrowed money in its capital mix, a business may be able to reduce or eliminate risk. However, equity investors will see a decrease in earnings as a result of this change. Consequently, the utilization of borrowed money by a finance manager must maximize the advantage to equity owners. Long term, however, EPS will not be considered a deciding factor in the company's capital structure. It's important to keep the concept of wealth maximization in mind. Next factor, we will touch about external factor, which is size of the company. When the size of a company is modest, the amount of money required is insufficient. A significant quantity of money is needed if a company's business is substantial. If a company intends to raise a modest amount of money, it will choose just a few securities to include in its capital structure. If additional capital is required, a variety of assets will be used to generate money with more flexibility in capital structure. Secondly, flexibility. Flexibility is a more essential factor when raising debt. The debt may be generated as and when finances are needed, and it can be paid off as when desired. In the case of equity, however, once a fund has been generated via the issuance of equity shares, it cannot normally be decreased without the approval of the court and compliance with a number of legal requirements. Last but not least, period of finance. Funds are needed for a variety of reasons across a variety of time periods. To fulfill working capital needs, short-term 1 to 3 year financing are needed. As a result, It is raised via commercial banks, OD or cash credit. Furthermore, to fulfill growth and diversification objective, medium-term financing 8 to 10 years is needed, which may be obtained via the issuance of preferred or debenture stock. Funds are required on a continuous basis for a business to fulfill its capital expenditure. This may be raised by issuing stock. As a result, the financial term will have an impact on the capital structure. Okay, now we will go to financial distress. Financial distress occurs when a business or person is unable to produce revenue or income because it is unable to fulfill or pay its financial commitments. This is often owing to large fixed costs such as overhead or wages, liquid assets, or income that is susceptible to economic downturns. Financial distress that is severe and persistent may ultimately result in bankruptcy. To avoid things getting worse, it's critical to deal with financial distress as soon as they arise. Financial distress may lead to a slew of issues if they aren't handled right away. For example, a person or a company in financial problems may see a decrease in their credit score. As a result, lenders would charge them higher interest rate, making it more difficult for them to borrow more cash to help them get through a period of reduced income or revenue. Okay, now we will discuss the integration of tax effects and financial cost distress. It is the expense of a financial distress scenario in which a business struggles to repay debts and commitments. Expenses linked with financial distress include indirect fees, conflicts of interest, bankruptcy costs, and a higher cost of capital. When promises to creditors are not kept or are only partially kept, financial distress results. Bankruptcy can be a result of a severe financial difficulties. Skating on thin ice isn't impossible, but it's not always fun. Leveraged companies are a source of concern for investors because of the possibility that they will go into financial difficulty. The present market value of leveraged firms' securities reflect this concern. According to the prospective and study result, a firm's worth increases as it begins to shift away from equity and toward debt. Now, let us consider the effect of debt financing. The risk of distress is low in this case due to the current value of the lowest distress cost. Thus, each rise in the value of loan increases the present value of discharges. It will eventually match the growth in the present value of the tax shield. Here, bankruptcy will grow fast as a result of tax shield, resulting in a fall in business value. Okay, now we will talk about agency cost of equity. The agency cost of equity arises as a consequence of shareholder management conflicts. When management makes a decision that is contrary to the shareholders' interest, the shareholders bear the cost. Thus, the agency cost of equity is the cost of shareholders monitoring management's decision making. The agency cost of equity exists as a result of contrasting interests of shareholders and management. As long as management's interests are at odds with and those shareholders will pay this expense. Management may be enticed to make poor choices that do not maximize the firm's worth. Any step used to monitor and avoid this will have a cost. Thus, the agency's expenses will include both the cost of suboptimal choice and the cost of monitoring management in order to prevent them from making such judgment. Okay, first, the pecking order theory. The pecking order theory, alternatively referred to as the pecking order model, is concerned with a business capital structure. Stuart Myers and Nicholas Machluff introduced the theory in 1984, stating that managers analyze finance sources in a systematic way. Managers favor the following sources of capital for investment possibilities according to the pecking order theory. Retained earnings come first, followed by debt, and finally by equity financing as a last option. The concept of asymmetric information may be used to generate the notion of pecking order. It is called information failure when one party has more knowledge than the other, resulting in an imbalance of transaction power between the parties. Finally, the last topic, which is signaling hypothesis. According to the dividend signaling theory, companies that pay the highest dividends are or should be more profitable than ones that pay smaller dividends. This idea implies that the signaling theory may be called into question if an investor evaluates the extent to which current dividends serve as a predictor of future profitability. By consistently raising its dividend year after year, a firm may be sending a signal to the market that its management and board of directors are optimistic about the company's long-term prospect. It is common for dividends to be held steady unless the board of directors is certain that the spending can be sustained or expanded.